Silver closed February at $92 per ounce, while Western futures settled at $94.30. That makes 10 consecutive monthly green closes, the longest winning streak since the historic run into 1980, when silver surged from $6 to $50 in 18 months. Gold closed its seventh straight month at a record high, the longest such streak since 1973, with Western spot sitting at $5,278. In just 2 months of 2026, gold has gained 22%, while silver has climbed 31%. Normal numbers they are not. Numbers like these show up when markets are pricing something most analysts refuse to discuss openly. 3 hard asset classes are spiking in unison right now. Oil, gold, and silver are all moving higher together. When energy, monetary hedges, and industrial metals climb at the same time, they are not reacting to isolated headlines. They are pricing the same underlying force: geopolitical risk at a scale that threatens supply chains, shipping routes, and currency stability simultaneously. On February 27th, Secretary of State Marco Rubio designated Iran as a state sponsor of wrongful detention and told all Americans currently in the country to leave immediately. The State Department's language was unambiguous. The Iranian regime must stop taking hostages and release all Americans unjustly detained. China ordered its citizens to leave Tehran. The U.S. has assembled the largest concentration of air and naval assets in the Middle East since the 2003 invasion of Iraq, while nuclear talks in Geneva ended without a deal. $650 billion was added to the precious metals market cap in hours as this unfolded. Markets do not move like that on speculation. They move like that when informed capital is hedging against tail risk scenarios before those scenarios fully materialize. Does this mean war is certain? No. But positioning reveals what informed capital is preparing for, even while official statements still emphasize diplomacy. Oil supply disruptions through the Strait of Hormuz, shipping route closures, and accelerated currency depreciation are all being priced into hard assets simultaneously. Meanwhile, the Shanghai premium on silver has widened to $12 per ounce. Western spot sits around $93, while Shanghai spot trades at $105 and Shanghai futures at $108. That gap tells you something critical. The physical market and the paper market are pricing 2 completely different realities. Shanghai is paying a 13% premium over Western exchanges to secure actual metal. When that premium widens during a rally instead of narrowing, it signals that physical demand is overwhelming the ability of paper markets to keep prices suppressed. Stress fractures in the paper market are now visible to anyone reading vault reports. On February 26, Comex registered silver rose 2.3 million ounces to 88.4 million, with additions from HSBC at 824,000 ounces, Loomis at 964,000, StoneX at 307,000, and Brinks at 111,000. Yet eligible metal fell 2.6 million ounces to 272 million. The net result was an outflow of 306,000 ounces, bringing total Comex silver to 360.3 million. Total Comex inventory has dropped approximately 31%, from 532 million ounces in October 2025 to current levels, a drain of over 170 million ounces in 5 months. Beyond daily vault fluctuations, the deeper signal sits in open interest. Comex silver futures open interest has collapsed from 162,000 contracts a month ago to roughly 118,000 today. That represents a 27% decline, while price climbed from the low 80s to $94. Managed money gross long positions have fallen to just 12,222 contracts, with a net long of only 4,569, the smallest speculative footprint in years, according to the most recent CFTC Commitment of Traders data. Winners do not exit winning positions. So who is leaving? The commercials and the hedgers. They are migrating to over-the-counter markets because Comex margins have become prohibitively expensive, liquidity has deteriorated, and execution quality has degraded as high-frequency algorithms arbitrage every angle of the exchange. The actual participants who need to hedge physical exposure can no longer use the exchange efficiently, and that creates cascading problems downstream. When dealers cannot hedge properly, they cannot manage risk on their balance sheets. Some compensate by widening spreads on retail transactions, charging larger premiums when you buy and offering less when you sell. No conspiracy there, simply how stressed businesses protect themselves when the tools they depend on stop functioning. Be aware of it when you transact. If a dealer offers unusually cheap or free storage, consider why. Low fees can lock your metal into their system, or you discover significant discounts when selling back, or delays stretching weeks before payment arrives. Storage and purchasing are separate decisions. Look for a custodian that is not simultaneously your dealer, because when the company storing your metal is the same one offering to buy it back, the conflict of interest is structural. Silver lease rates have surged to 1.6%. For context, the average was 0.04% in 2023 and negative 0.18% in 2024. When lease rates spike while premiums widen and open interest collapses simultaneously, you are watching confidence drain from paper systems in real time. The cost of borrowing physical silver has multiplied precisely because certainty of delivery has eroded, and lenders no longer trust that metal will come back. Jesse Livermore wrote that the big money is made in the big swing. Multi-year supply deficits, geopolitical fragmentation, and accelerating central bank purchases are converging into exactly that kind of swing. Most participants will miss it, waiting for mainstream confirmation. By the time consensus arrives, the largest portion of the move has already occurred. Independent thinking means positioning based on probability before certainty arrives. That is uncomfortable by design, because if it felt comfortable, everyone would already be positioned. Consider what is actually unfolding. 10 consecutive green monthly closes making history. Gold posting its 7th straight record. The Shanghai premium widening through rallies while Comex open interest collapses 27%. Lease rates at 1.6% when recent years average near zero, and $650 billion flowing into precious metals as U.S.-Iran tensions escalate toward a potential inflection point. Decades of price suppression through paper mechanisms do not create stability. They create fragility. Every intervention compresses the spring tighter, and compressed springs do not release gradually. The participants who accumulated at $72 understood that sentiment extremes create opportunity. Those who will panic sell the next correction never learned the difference between temporary price action and the underlying thesis driving a structural move. Verify every claim independently by checking Comex vault reports yourself, looking up Shanghai premiums, and studying how crowds behave at extremes to develop your own framework. Be careful where you store your metal, because conflicts of interest are real. The ones who verify the data already see the pattern. Invest with logic rather than hype.